and thanks for having me. There's a graveyard full of startups that actually did not manage to get from initial traction to sustainable high growth. And many of the founders actually tried to sprint through the growth valley of death. And I bet here are many founders, and I also bet they do not want to end up 6 feet under. I bet they are thinking about how to grow their businesses almost daily. And this is probably the reason why Jan invited me here today in order to talk about FastScaling, which is a growth strategy described in my respective book. FastScaling promises high growth, a massive valuation, and less founder dilution. If you fast scale, it takes you a bit longer to succeed, but eventually the probability that you succeed is significantly higher. Is fast scaling the only growth strategy? No, it is certainly not. We all know blitzscaling, for example, a term coined by Reid Hoffman and Chris Ye, a great book that almost every founder has read so far. So fast scaling is not the only growth strategy. It's up to you as a founder to decide which growth strategy suits your business, your business model, and the market that you are active in. And you have to choose the right investor for your growth strategy. A lot of responsibility on your shoulders, but I've got good news. There have been very bright people thinking about this topic, how to actually succeed in terms of growing a business. And here, I'm not referring to the ones who run around saying startups fail because they run out of cash. What's the point? I'm referring to smart people like Genome Report, Stanford, Berkeley, who jointly analyzed 3,200 startups in order to figure out what makes companies succeed and what makes others fail. And the result was astonishing. 70% of all startups failed because of premature scaling. 70% of startups failed because of premature scaling. So if you avoid premature scaling, you are already among 3 out of 10 startups that may succeed. But what is actually premature scaling? Well, it comes in many shapes and forms. You accelerate growth before you have found product market fit. You invest heavily in growth before you have found a channel through which you can sell your products and services on good economic terms. You invest in growth before your unit economics show actually that you have validated the business model. And how can fast scaling then help you here? Well, after now 16 years in private equity and venture capital, after having worked with startups and scale-ups, I have seen one common pattern. Unless speed into the market is the critical strategy for your business, for your market, until you reach this strategic inflection point where you need to prioritize speed over efficiency, you may be better off first validating the business model and then scaling fast. First validating the business model, then scaling fast. And the rewards are astonishing. The study conducted by Genome Report, Stanford, and Berkeley also revealed that the companies that avoided premature scaling actually grew 20 times faster than the ones who scaled prematurely. This is why fast scaling promises higher growth, massive valuation, and due to the cash efficiency, less founder dilution. So tomorrow there will be a workshop on certain growth strategies. We will talk about blitzscaling and fast scaling and also dive deep into the building blocks of fast scaling. But I want to touch upon the 9 building blocks of fast scaling here briefly. Essentially, there are 2 pillars. First, you build a high growth foundation, a solid foundation for your growth, and then you fast scale. And as I said, there are 9 building blocks. First, the foundation. You focus on generating product market fit. And here I hear founders saying something like, well, look at our revenue growth. They show it, the revenue growth shows that we have found product market fit. In fact, no, this can be a false positive. I have seen too many founders pushing products and services into the market, showing top line growth, but in fact, also after a certain period of time, the customers churned. It was not sustainable. If you want to generate product market fit, if you want to measure it, look at your cohorts, look at usage, look at customer retention instead, maybe also at NPS. Marc Andreessen famously said, product market fit is all that matters. I think it was a little bit provocative because in fact, it is not all that matters. How good is a product if you cannot sell it through a distribution channel that is made for this product? Or the other way around, a product that is made for the channel, because what you can actually do is only mold the product to the channel. So product channel fit is the second building block. And if you have found product market fit and product channel fit, this usually translates into strong unit economics, which is the third building block. And it's not only about customer lifetime value and customer acquisition costs. I mean, if you have found product market fit, people will buy, they will stick around, they will maybe also tell others about the great product that you have. So customer acquisition costs go down, customer lifetime value goes up. Even more importantly, usually you can also see a short payback period. What does this mean? You can recoup the investment into customer acquisition fast in order to reinvest the same money in order to acquire ever new customers. And this is probably one reason why the companies that avoided premature scaling actually ended up scaling even faster. The fourth building block is a technology that is scalable. This is something that unfortunately many founders forget. If growth kicks in, if revenues soar, you should not eventually fail because your technology can actually not cope with the high usage, the high traffic that you experience. And the fifth building block should actually be something that you have looked into before you actually embarked on your venture. Is it really a huge market? Many founders overestimate the market size. And I can share with you that many investors experience what I experienced when we look at pitch deck, huge bubbles, 8 billion market, 80 billion market. In fact, if it comes to market size, then you should be precise. You should pursue a bottom-up approach, analyze your total addressable market, your serviceable obtainable market, and your serviceable addressable market. And being precise here helps you because market sizing will accompany you throughout your journey. When you approach new markets, want to develop new products, it's all about understanding the market size. If you have all these foundational elements in place, you can then fast scale. It's not about just adding marketing and sales resources. It's really about still focusing on customer success. Make your customers happy. Their preferences will change. They might stick around somewhere else. You might have to adapt your product. You might have to use different channels to your customers. And if you still delight your customers, your unit economics will still be stellar. And in a great market, this will lead to strong growth. And the seventh building block is predictable revenue. Certainly, you want to have predictable revenue. This is also what investors look for. It's nice to have a deal closed every once in a while, but what we want to see is predictable revenue. And this is about analyzing and planning the forecasting your business. And again, not only top line growth, but also cost, EBITDA, cash flow. And again, what some founders forget, it's also about hiring plans. This is often a bottleneck when it comes to scaling a business. Where do you can actually find the right talent? So be precise and take your time to plan thoroughly. In turn, and this is the eighth building block, you can scale cash efficiently. You understand what it means to grow. You can nicely balance growth with cash. Cash efficiency comes naturally with fast scaling, but you can also avoid some typical inefficiency patterns that I have experienced when working with founders. Creating too much complexity is a good example here. Last but not least, it's also about leadership, the ninth building block. You need to be a strong leader. You need to be a role model. If you only look at the next 4 weeks revenue, don't be surprised that your employees do not care about customer success. When I enter offices of startups, I usually see the screens at the walls. And I always look at what is on the screen. Is it only top line growth, or are there also metrics dealing with customer success? Quite interesting. And you do not only have to be a role model, you need to also be self-aware. Know your strengths and your weaknesses and hire people who are better than you. You as a founder need to understand on a high level everything around your business, and you need to ask the right questions and dive deep if necessary. This is what my book helps you with. But you need to have the right people in the right seats and hire better people than you are. So let me wrap up. Aim high, be ambitious, strive for building a massively valuable business. But if someone asks you to only look at top line growth, question this. Is this the right strategy for you? Or might you be better off first validating your business model and then scaling fast? We will dive deeper into this tomorrow in the workshop. But if you fast scale, it may take you a bit longer to succeed. But the probability that you build a massively valuable business is significantly higher. Thanks.